All right, so we talked about a couple of scenarios coming into this week. One of them being akin to BYU winning, and the other being lower odds, and the other one being akin to Utah winning, which is the higher odds scenario, and the big rivalry game for my alma mater over this past weekend. Well, from a football standpoint, it was a great weekend. From a market standpoint, the higher odds scenario played out to where we actually gapped up today, and then we didn't hold those gains, but that's okay. We're not expecting a breakout move to the upside, but we were expecting that we would, kind of halt the weakness we saw last week, take advantage of some seasonal moves to the upside, and then we'll see after. So I'm going to talk about that to see, what, if anything, that's changed. Going with today's move, how today's move impacts that, and what we see, and what kind of trends we're seeing, whether it's U.S. stocks or other asset classes, whether we're trending towards risk appetite, whether we're trending towards risk aversion. So we're going to break that down, see how the sectors performed. There's a couple of interesting outliers today. And then our trade idea takes advantage of a stock that's kind of got a little bit of a bullish breakout itself, not a very strong one. So we'll talk about how to trade a bullish breakout when it's not as strong. Compared to some recent ones we have that were a little bit stronger. So let's go ahead and get started. Today is Monday, September the 13th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast with the on the S&P 500 like we always do. You can see after finishing a smidgen below the moving average on Friday, light pink shading, yellow line, we finished a smidgen above it today. So we were minus 0.16. We were plus 0.01. So that's about as low, and this goes to 2 decimal points. So that's about as low as you can get, being above the moving average here. Kind of a neutral candle, a shooting start, or no, excuse me, a doji candlestick pattern, spinning top, whatever you want to call those. Obviously, with an oversold near-term, short-term sentiment, you'd expect that we're going to get a little bit of a short-term bounce. And, barring the type of pattern that we would have seen, like a big opening gap, a big runoff from the open, that's kind of what we talked about. That was about as the same odds as BYU winning. Well, BYU did win. Some of you caught that in the last video. BYU ended up winning on Saturday night, which was great. It's a great weekend to be a BYU fan this weekend. But the according pattern did not occur this morning. So we knew right off the bat, when you woke up before the market opened, you realized we're not going to get that pattern today. So because we gapped up to the upside. So that was a good sign. That means that more than likely, with Friday's inflection, that we were not going to, move to the downside, that the rest of this week was going to be what the higher probability scenario of just grinding higher up into expiration, and then the seasonality. Remember, the seasonality for the S&P 500 here is to move lower after expiration, right? So post. So expiration this week, this time is on the 17th, so right there. So it's a few days after is when we really start to work our way to the downside. In fact, you could even say it's towards the end of that week after. So it's a little bit after when you finally start getting a downward move. So I expect that we'll continue to grind. I don't know if we'll get to a new all-time high this week, but I think we'll get a new near-term bounce, get the near-term line up into bullish territory. Now, whether it gets above 80 is a different story considering how low it got. But I do expect that we'll get up above 60 into bullish territory. And then we'll see from there, right, by Friday what ends up happening. I don't think we'll be that bullish. I think that we'll start to work our way into some seasonal weakness post-September expiration going into the beginning of November. This is kind of like that worst 6-week period in the market. So that's kind of what I'm expecting to see, especially, again, considering we're now more than 10 months along into this intermediate run that we've been on. And if you recall, the Dow Jones Industrial Average is, it bounced up today 0.7%, but you notice not enough to, get in either short-term sentiment line up to strong levels. They were very oversold on Friday too. And you notice also not enough to get you back above the 23% retracement level, which is when the retracement ends, and not enough to get above the moving average, which is what would turn that red line around. And again, not enough. The intermediate line still even more in bearish territory, headed towards lower reversal zone. So hardly a bullish, strong bullish move. And again, remember, we get our biggest bullish moves below moving averages, not above them. So So keep that in mind too, that we're below it. So, you're going to get a move like we got today on the Dow Jones. That's the only major index that's showing bearishness, right? Because the NASDAQ is still dark green shading and a green line. The S&P 500 obviously was light pink shading and a yellow line, but now we're back to green, and we're still in bullish territory. And then, of course, the Russell 2000 is kind of up and down here. Again, it's back above its moving average, but still pretty darn neutral, sitting right in the middle of this range between its 23%, 0 and 23% retracement level. So again, and you have a convergence going on with the intermediate line, but it's still in bullish territory despite its convergence, and you're a smidgen above. After being below the moving average yesterday, we're back above it today. So, so it's still like, noise. I know it wouldn't get me a job on CNBC, but the reality is it's just noise, up and down. There's no trending moves going on. I mean, there's a little bit of a trending move going on right now. Here, let's come over here to the Ichimoku cloud. There's still a trending move going on in the S&P 500, but the diamonds is no longer trending. The Russell 2000 has no longer trending. It tried to get going to the upside again and failed again, just like it did back here in June. So it's back in noisy territory. It's not trending. Of course, the Qs are still trending pretty good, but they're not trending as strongly as they were, and they're headed back towards not being nearly as straight. Again, kind of not getting above 5, not getting above 80, which is kind of what you'd expect. When you come off a strong bullish posture, it's really kind of hard to start a new one, right, back to back like that, without getting some kind of, pullback, right, exhale, where you get some red bars. And we never did get red bars. And so it's actually a little bit more similar here, when you get kind of a bullish move. On the S&P, on the Qs, we didn't quite get it. On SPX, you can see you got a bullish move, and then you got a new bullish run coming out after it. That kind of leads to, more of a broader exhale. If you don't get, here you got a bullish move, and then you got another bullish run, and that led into the exhale that you had there. So it's rare to go from being so strong, and that wasn't nearly as strong, but going from so strong to going right back to being so strong again without some red bars in there. And that's why I don't expect that we'll get back above 5 and 80 on the Qs. So we are in convergence mode. We're just not in exhale mode yet, right? We're not pulling back, but we are converging. And again, what is convergence is when your MACD is above 0 and you're dropping below 0. When you're moving towards 0. Obviously, on the daily chart, we get multiple convergences, and we're just on another one right now. But if you go out a little bit longer term to a weekly chart, then you can see, we are in convergence mode. And we've been kind of in some convergence mode there too. But the lines are getting closer to each other, and that's the kind of mode you expect. We are not below the 8-week moving average. That's when you really start to, worry about more of a convergence, like we saw over here. And that's when we actually had our intermediate pullback, when you broke below the 8-week moving average. We haven't done that yet on SPY, and neither have we done that on the Dow. Though the Dow is, you can see the convergence going on since the beginning of May on the Dow. That's what a convergence looks like. We're still bullish, but we're converging. And we had an intermediate pullback, if you recall, on the Dow. We're getting one right now on the Dow. And of course, IWM has had even more of a convergence from that peak going down, as you've really been up and down above this. This is the 30. Remember, this is a weekly chart, so this is up and down above the 30-week, and the 50-week is catching up that quickly. But the Qs, of course, we had a new divergence here after converging here for a while. And really, you kind of look at that. You get so much choppiness. You kind of look at the orange line for that convergence. And of course, the orange line can't start dropping until the blue line gets below it. That's when you're negative on this. So that's really when you start to converge, is when you get the red bars. And it looks like that's kind of where we're headed. The histogram is down. It's close to going negative. So, the MACD is peaked. MACD peak there. Now you get the red bars, and you start. That's when the convergence starts. That's when the convergence starts. That doesn't mean that even an exhale starts. It just means that we're until we break that. In this case, the 17-week exponential moving average is when you really get significantly bearish But of course, when you look at the 17-week moving average here, where it's at, it's well into this is the 17-week, not the day, but look how far into that 0 to 23% retracement level it is. It is very far up here. So a break below the 8 is your typical, like we saw over here, your typical intermediate decline, and you're flirting below the 17. But breaking below the 17 and the 30 for that matter would be more of a market sentiment type decline, as you see here. This one especially, market sentiment decline, and of course the COVID drop. And you notice the blue line is at the 23% retracement level, the 30-week exponential, and it's rising. And there's not a lot of volume when you're looking at a 5-year basis. So a lot of this rally in the last 5 years has occurred in the last year, right? At least according to the volume here. An inordinate amount of the rally. When you take a look at the Hakinyashi candles for the weekly chart, you can see, hey, look at that, a bearish candle. It's crazy, but it's a bearish candle. We haven't had a bearish candle in Hakinyashi, which again, it means a negative number here all the way since right there. That was the last one in mid-June. And then, of course, and that's 3 months ago. And then, of course, here in May, remember the NASDAQ had a pullback there. The NASDAQ had a pullback here. It's when you go negative is when you tend to get the pullbacks, right? There's your the actual intermediate pullback there. And then the Russell kind of had one there. And then you can see some real pullbacks in this area. When you get these candles at about get down to that 2.5%, 2.25% level. Well, again, we're pretty far down there. We are about the same level, almost 1%. These are both this is the 0.5%. These are 1%. We're at 0.5% now. So it's not the biggest negative candle, but it's, a pretty decent size. You notice here, let me go back to, let's look at the Dow on this one. The Dow Jones is even that much more negative. So just remember, this is when the Dow had its intermediate pullback. You get the red arrow. So you got the negative number here and a red arrow. You saw that a couple of times with the NASDAQ over here. Negative red bars and the red arrow, and the negative numbers. So those were the two pullbacks on the NASDAQ. You can see on the Russell, the negative bars here with lots of red arrows. So we've had lots of attempts at pullbacks here. Not once have we had that on the S&P 500 since this level. Like not a single red arrow. A few times where we were negative, just barely, but not a red arrow. And we're still not getting a red arrow this week. So that's the important thing to kind of watch. And I don't think we will get it by the end of this week on the S&P 500, as I expect we'll grind higher. Let's take a look at some of these indicators. You can see, we're flirting with negatives, but we've done this before, and it looks like we'll probably do it again on the S&P. It's a matter of where the next near-term rally peaks, of course. The Russell 2000, is not in bearish territory at all. The Dow Jones, on the other hand, did get down below 40. It's bouncing back up. It did get to negative 200. It's bouncing back up now again. Will it get back up above 60, or is this the breakthrough that will now keep us down? That now will probably peak around 50. That's kind of what I expect, is where we'll kind of peak around 50 there. The NASDAQ, of course, very still strong. I mean, this is the best one out there. It's the safe haven. It's the strongest bullish indicator right now in terms of directional movement. We talked about this. We're below the green line, but above the blue on S&P. We're same thing on these small caps. Below the green, but above the blue. Below the green, above the blue. Diamonds, below the green and the blue. To the point where now we've stayed below the blue, so we didn't bounce right back up, and the green line is crossed below the blue. So that's kind of a negative indicator for the diamonds. If you look at the directional movement index, of course, we don't have a directional move going on SPY or the Qs. They're both between 20 and 25. If you look at IWM, not a directional move there either. And if you look at diamonds, boy, did we get, that positive indicator is extremely low. It's about as low as we were over here. And we're not nearly as bearish. I mean, the negative indicator was extreme at that point in the last pullback. Not so extreme this go around. So fascinating to see, just how not very positive we are according to the positive index, but not very negative associated with that either. So we're still not, kind of breaking down yet. And again, like I said, I don't expect that we will. Let's take a look at the intraday chart for these indicators. Of course, we gapped up, which was a good sign because remember, what we need to see down here, if we're going to really kind of break down into exhale, is a significant gap to the downside, in a 2% and or 2% drop. Ideally combined, if not separated by a day with a spike in volatility. Didn't get that. We didn't get. I mean, we got a significant gap to the upside today. So that, like I said, we knew right away that we weren't going to get that lower odds scenario. But again, still we got a lower high, lower low. We're above the low points there. The diamonds got an inside day today, so that kind of halts a little bit of the negative momentum with both the high and the low inside the range from yesterday, closing closer to the high of the day. So it's a relatively positive development. Again, I think we'll probably move up towards this area by the end of the week on the diamonds. Your IWM is looking relatively, again, lower high, lower low, but above yesterday's low and closer to today's high. So relatively bearish, neutral, not as bearish in that regard. I don't think we'll be strongly bullish. I think we'll be more neutral from day to day throughout the rest of this week. Here's the the green arrow chart. Here you can see, we had light pink shading there. It's gone already. We don't have 3 red arrows on the Qs, of course. The IWM had light pink shading, but it's gone already, just like that. Again, you get those light pink shadings, you either bounce right back up a day later or 2 days later. You see here, you can see here, or we don't, right? Like you saw here and like we're seeing right now on the diamonds. So that's your sign of pullback, and these are your signs of bounces on this SPY and IWM. So that's what we're getting there. But look at the volume, 82 million shares. The trading range was high, 4.81 points. Those are high numbers. 4.81 is right there. So it's not extreme, but it's above the average. 82 million, not extreme, but above the average. So those are bearish numbers. So again, that's not necessarily like, oh, this is comforting, right? It just means that we continue to get, like, when these lines go up, it's associated with risk off. Even if we were kind of sideways, I remember the Nasdaq had its pullback here. The Nasdaq had its pullback here. The Russell had its pullback here, and now the Dow is getting its pullback right now. So obviously, when we get everything in line, when everything is dropping, we get an actual intermediate pullback. This is what it looks like, right? This is when everything was dropping. Back here in September, October, we were up nearly 2% on the ATR to price, and we're still at 0.75% right now. So nowhere near being towards the end of an exhale right now. So and then of course looking at volatility, that was an important consideration over the weekend because we had closed at 90. We talked about ideally we're probably even more likely we're going to hold that for resistance and come down. It's very typical. It did. I don't think we'll drop all the way to 80 though. I think we'll stay relatively volatile all week, staying in this 85 area, and then work our way up after expiration. So that's my technical outlook for today, and then going into the week. We'll see how that changes maybe by Wednesday, but that's kind of what I'm seeing right now. What do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggests why you're either a lot more bullish than I am, or that you're a lot more bearish than I am right now? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked the video today and you want us to do another video again tomorrow. Quick way to give us feedback there. Comment down there anything that stood out to you from our video today. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, click on this icon right here on our Market Outlook Live. That takes you to our Market Outlook Live page. As you can see, here's where we house. I review all the trades that we do in these videos on the Market Outlook. We looked whether we should stay in them, get out of them. We talk about why and how. So this is where we do that. We also put on today's trade idea already. So you can click on that link to get to that site there. Here's our trading rooms. You can see tomorrow's GGI class and brand, one of our most popular classes we have here. My options class that I have tomorrow as well. You can see all the rest of our trading rooms here by clicking on this link, trading rooms. It takes you to our calendar here. All of our recordings going back 3+ years now, as well as our upcoming classes. Again, those things are available for our Plus subscribers and our Premium subscribers. Our Premium subscribers get access to that for less money per month on average, as well as in addition to that, you get access to our class forums, as well as our premium tools and resources that we have. Come down here, click on this heart. It opens up a new page. Hit that like button right there. Also click on this thumbs up icon. It opens up another new tab. Hit that like button there as well. Again, the more you do that, the more our content gets out to all of our followers on Twitter and Facebook with how these algorithms work for them. It benefits you because Twitter and Facebook promotes content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's talk about how things are going with the different asset classes. You can see the euro, the dollar's been rallying, the euro's been pulling back. It's got light pink shade and yellow line, very similar to the S&P. Gold has been doing that too. Bitcoin is down, light pink shading in the yellow line. All global stocks are down, including developed market stocks, which aren't down as much as the S&P, not flirting with their moving average, and emerging market stocks, which are actually still dark green shading and green lines with an 81 intermediate line. Developed markets are at just below 80, so just barely light pink. Silver, of course, is still dropping. Copper is still kind of midway. A couple other relatively risk-on type assets within the metals category. So you can see it's not really, even bonds are flat. So we're not really trending in a risk on mode. We're not really trending in a risk off mode either. It's very neutral across a lot of these indicators. If we take a look at how they performed today alone, you can see how they've been performing the last 3 months. The Qs have been the safety trade with developed markets and small commodities and emerging markets and small cap stocks all down here. Incidentally, with gold being down there as well. But if you look at just today alone, let's come over here. You can see, international stocks did well, commodities were up, but so were real estate and long-term bonds and small cap stocks. So not really again, that's not strongly risk on. It's something because emerging markets would be up there instead of developed markets. It's not strongly risk off because you have stocks up here with bonds and real estate, and you have your Qs down here at the bottom with the dollar. So very neutral day. Pretty much, in fact, just about everything was up except for the little small drop in the dollar, and a small drop in the Qs as well. Everything, they came off their lows by the end of the day, so everything was up compared to the dollar. The dollar being what all these things are priced in. So relatively bearish move. In fact, if you take a look at this chart, which looks at all these dollar-based currencies here in the 12 grid. Actually, this one here, you can see here's all the major currencies against the dollar: the euro, the pound. They're all, again, kind of neutral. The Kiwi is up a little bit, but everything had been pulling back against the dollar. Here's the dollar compared, when it's the base currency, flat against the yen, very neutral against the yen, neutral against the Canadian dollar, relatively neutral against the Swiss franc, which is your safety trade over there in Europe. Euro and the pound's not going anywhere. And then, of course, you can see Australian dollar is neutral against the euro. It's neutral against the yen. This is kind of a risk, a proxy for risk appetite as well. And your euro and your pound are neutral against the yen too. Again, another proxy for risk appetite. So currencies aren't showing us anything. A lot of these asset classes really aren't showing us anything in terms of trending. We are just very neutral. Long-term bonds. Look at the intermediate line, stuck right there in between 50. So I think that this is the kind of mode we're in. We're not going to trend out in risk appetite today. We'll probably trend towards the upside of this range we're in, but I don't think we'll trend up to new highs. I don't think risk off is breaking out today either. I think you just have a lot of different asset classes that are all just very neutral, kind of waiting maybe for September expiration, waiting maybe for a catalyst or two that might be out there. Again, that's not known, because if it was known, the market would already be pricing it in. So, I mean, that's why your skew, when your skew is as high, when your skew here is as high as it is, that means that the market is, concerned about, this idea of something significant coming out to the upside. So let me go back to 1 year, so we can see. You can see where the average. I mean, we're still at 151.6. It hasn't been updated yet for today, but we're below the average though. Again, that's typically associated with kind of risk-off mode. So again, it doesn't necessarily mean we have to pull back. The Russell 2000 is what pulled back there. Your NASDAQ is what pulled back over here and over here. So it doesn't necessarily mean the broad market is, but you are below that moving average there. When we look at the trend indicator, again, it's still relatively low too. So I mean, that's a very neutral. Being right around 1 is very, very neutral. We're very low. It's actually a little bit bullish. We've looked at these new highs and new lows as well. This has been updated for today. You can see the average has really dropped down again. When you get these, when we get below 0 on the new highs versus new lows, those are associated with pullbacks as well, even if they are only individual pullbacks on individual indexes instead of the broader market. We are still, right on its moving average. Its moving average is low, but it's right on its moving average. So again, kind of just shows just how neutral we are in the broad markets. Not breaking out one way, not breaking out the other. Of course, we still got a lot of stocks trading below the 50-day moving average. This hasn't been updated yet, but well below the mean. That's associated with risk off. It's definitely not risk on. We're not breaking below 1 standard deviation like we did in these pullbacks in September, and of course like we did over there in February and March. But we are definitely not in the upper half, above the mean, which is what's associated with bullish trending moves. So we're not bullish, we're not bearish either. We are in this very strongly neutral, if you can say strongly neutral, environment. Again, there's seasonality for us to kind of lean towards the upside of this neutral environment to the rest of this week. But I don't think we'll do anything more than that. And I don't think we're breaking down this week either. So expect a lot of nothing coming into Friday's expiration. Once we get through September expiration, any pending involved with that, then we'll see. Of course, things might change Wednesday night when we do this again, but we'll see what ends up happening there. Let's take a look at how the sectors perform. So bear with me 1 second to pull up the sector performance here. So we'll come over to the 12 grid. Here's all their charts, and you can see again neutral, light pink shading, yellow lines, not surprising, all across the board. Some dark pink shade or red shading and red lines, like you see with the Dow Jones Industrial Average. You can see energy is looking, relatively green, but just 55, so it's not above 60. The only one that is above 60 here that's green is discretionary, so it's still maintaining some strong bullishness, and that's really where the strength is lying. Everything else is below 60 aside from utilities. So we're not really very strongly bullish, across all these different indexes. And then when you look at our sectors, if you look at how they performed today, you can see technology has been your, that's the Qs essentially. It's been your bigger winner. If we take a look at today's move, then you can see energy, financials being your bigger winners, which is kind of interesting because they've been the biggest losers lately, and they bounced up. And healthcare is down. Everything else is just doing a bunch of nothing. So some volatility in some volatile areas, in particular these two volatile areas, and not much volatility in any of the other areas right now. So when we take a look, that leads us here to our trade idea of the day. Our trade I wanted to take a look at was Disney. We actually have a trade ending in our class portfolio this week on Disney. But it's, after having been in a relatively neutral stance for multiple expiration cycles and really being very treating us very kindly in that regard, looks like it's trying to get a little directionality to it. We're breaking up above 80 on the intermediate line. Even with a little pullback in the near term, so we'll see if we can bounce off of this. pull back on the short-term sentiment line and get going again. We broke above the 23% retracement, kind of very similar to here. So we'll see, what the outcome looks like relative to how we performed over there going into July expiration. If you take a look at the, that was what 2 months ago. So we're not, it's not a quarterly cycle that we're seeing there. If we take a look at the long-term chart for Disney, we obviously did have red arrows and negative bars. So we did have, a pullback on that. We got to the 38% retracement, but we're getting bullish candles. We're above the 50-day moving average. We got some positive Hakunashi. The PPO is rolling to the upside. So some positive indicators there. Disney is showing 3 green arrows. So, we're in dark green shading. We might convert. We're in convergence mode a little bit. That's okay. Convergence is not a bad thing, as we've seen from a broader market standpoint, as long as we stay above the 8 and the 17-day moving average, which obviously we are still. And you can see where for the past year, all the volumes up here were above the point of control. So that's a relatively positive sign too. So we got support below us instead of resistance above us from that perspective. The RSI and the CCI look relatively positive. We did actually peak above. We got to 150 there. We've been trading in the upper part of the CCI's range. We're above 60 on the RSI. Those are positive indicators. The DMI isn't necessarily directional yet, but we are still above 30 and below 20. So it's about as, we've pulled back after its breakout move, but we're still directional from that definition. You look at the Ichimoku trend cloud, we are above the cloud. And we are above 2 and 65. So that means we are in a trending mode according to the trend quality and noise balance indicators down there. And then finally, when you look at our Bollinger Bands, we are flirting with the upper quartile, right at 74.5. Upper quarter, the bandwidth is rising. The bands have broken out of the Keltner channels here with rising momentum. So it's not a strong bullish directional move, but it's directional enough to do a directional trade on it. So what we decided to do was to sell a bull put spread. So we'll sell the 180 put, buy the 175 put for protection. We'll do a full position size on that. You can see we ended up getting a dollar. What did we get? 381 times 3, or divided by 3 is what we ended up getting per contract. But again, for $1,000 of risk, roughly, we typically go for about $350 plus or minus a little bit. In this case, plus a little bit, because we are above 1,000 a little bit there. So that's kind of what we're shooting for. So we got a pretty decent reward. That break even is sitting right on that point of control. So you've got some very, very strong support right here. So we can pull back and then hold that support, we'd be just fine. Okay, if we break, that's a different story, and I'm willing to lose $381 if that's the case. So we got a really good support that can help us see if that bullish pattern can play out enough for us to get a good return on this trade, on a relatively high probability trade here. All right, well, that does it for me today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any comments or questions you have about anything I discussed in the video today. Reply to anybody else's threads. Let's keep this conversation going among our viewers here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website for free, as I showed you before. Click on that thumbs up icon. Like us on Twitter and Facebook as well. We can get our content out to all of our followers. And then comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.